The crypto market is once again at a turning point, and this time, Bitcoin is showing signs of a move that could redefine the weeks ahead. After weeks of quiet contraction, price action is coiling like a spring, and traders around the world are watching closely. But this isn't about hype or wild predictions. It's about understanding liquidity, timing, and emotional control. In today's analysis, we'll explore what the charts are really saying, what upcoming inflation data could mean for risk assets, and how smart money is quietly positioning before volatility returns. Stay tuned, because what's happening beneath the surface might surprise even experienced investors. Let's break it down calmly, clearly, and with data-driven logic. You know that feeling when everything seems calm, but deep down, you can sense something big is coming? That's exactly where the crypto market is right now. Bitcoin's price has been tightening, moving within a narrow range, like a spring ready to snap. Ethereum too, quietly building pressure. It's what traders call a triangle pattern, and it usually means volatility is near. But don't mistake silence for weakness. Markets often move slow before they move fast. I've seen this phase many times. It's when smart investors stay alert, patient, and data-driven. Because once this energy releases, direction matters less than preparation. The next few weeks could define how the entire cycle unfolds. Are you ready for it? At the same time, we're seeing a slowdown in ETF activity, a sign that short-term speculation is fading. That's why the market feels quieter, almost sleepy, as algorithms move prices just enough to hunt liquidity and trigger orders. It's a game of patience right now. On the bigger stage, all eyes are on tomorrow's US inflation report. If the numbers come in higher than expected, it could make investors cautious about the pace of future rate cuts. But if inflation surprises to the downside, it might bring a short wave of optimism back into risk assets. Either way, it's a reminder that in today's market, data moves emotion, and disciplined investors always wait for confirmation before reacting. Adding even more pressure, global investors are closely watching the upcoming 155% tariff plan, announced by former President Trump, set to take effect on November 1st. While headlines sound intense, markets often react less to words and more to action. And right now, traders are waiting to see if diplomacy or negotiation steps in. This uncertainty is shaping global sentiment, especially across tech, commodities, and digital assets. For many investors, it's not just about politics. It's about understanding how trade tension can ripple through liquidity and confidence. Whether an agreement happens or not, this moment reminds us that staying flexible and informed is far more powerful than trying to predict every headline that crosses the screen. What's fascinating right now is that funding rates across major exchanges have turned negative, a clear signal that most traders are betting against the market. And when too many people lean in one direction, history shows the market often does the opposite. It's called a short squeeze, a sudden surge that forces bearish traders to cover their positions, driving prices even higher. I've seen it happen countless times. Quiet markets suddenly erupt as liquidity floods back in. But this isn't about gambling on reversals. It's about understanding sentiment. Negative funding doesn't guarantee a rally, but it tells us emotion is driving decisions more than logic. For disciplined investors, these moments aren't for panic, they're for preparation. Because when fear becomes consensus, opportunity often hides just beneath it. From a professional standpoint, this market phase isn't about chasing green candles or reacting to every headline. It's about building systems that think long-term. The smartest investors I've worked with automate their processes, track their performance, and let data make the hard decisions. That's what keeps emotions out of the equation. Patience and discipline aren't glamorous, but they're the foundation of every lasting portfolio. Think of it this way. The market rewards consistency, not impulse. Whether you're using algorithmic tools, journaling trades, or simply reviewing your strategy weekly, the goal is the same: progress through structure. Those who prepare quietly today often become the ones everyone notices tomorrow. In this game, timing helps, but systems win. During quiet market phases like this, something subtle yet powerful often takes place: institutional accumulation. While retail investors lose interest, larger players quietly build positions, focusing on long-term value rather than daily noise. This behavior is what many call the work of smart money. They don't chase momentum, they prepare when others are distracted. I've seen it time and again. During low-volume periods, the foundations of the next rally are quietly being laid. It's not about predicting exact bottoms, but about recognizing patience as a strategy. Institutions use data, liquidity zones, and time to their advantage, scaling in gradually. By the time the crowd notices, the move has already begun. So if the market feels slow or boring, that's often the signal that something bigger is forming beneath the surface. Quiet accumulation is rarely exciting, but it's where future winners are built. When it comes to building real wealth, the goal isn't to predict every move. It's to design a system that works even when you're not watching. That's the mindset shift I try to teach every investor and creator I work with. True financial freedom comes from process, not prediction. Imagine having automated systems, from dollar cost averaging to AI-powered alerts, that help you stay consistent without emotional decisions. One of my clients once said, "I stopped trying to outsmart the market, and I started building around it." That's the key. Whether it's investing, creating digital income streams, or managing cash flow, your system should do the heavy lifting. Markets rise and fall, headlines come and go, but process endures. Master your system, trust your discipline, and let time do its compounding work. Finally, remember this: markets rarely reward noise, they reward preparation. When everything feels slow, uncertain, or even pointless, that's often when the foundation for the next major move is being built. Institutional investors, the so-called smart money, know this. They accumulate quietly while retail traders lose patience. History has proven it again and again. When volatility dries up, opportunity begins to form beneath the surface. The next liquidity wave doesn't come to those chasing excitement. It finds those who stayed consistent, informed, and emotionally balanced. So take this moment not as a pause, but as a chance to strengthen your process, automate your systems, and refine your discipline. Because when the next phase begins, and it always does, the market won't ask if you're ready. It will simply reward those who are.